Hey everyone, I wanted to talk about a potential trade idea. Not so much for the idea, but more as an educational tool. So I do have a book that is in pre-sale right now. It is going to be available on Thursday. You can pre-order it now. It's called Building Berkshire. In that book, I reveal a step-by-step strategy that I've used to generate consistent cash flow and recover from losing trades and ultimately build long-term wealth like Warren Buffett. So I want to talk today about Nike. Let me just log in here really quick. These videos aren't going to be super fancy because I don't want to take a bunch of time to edit the content. I just want to deliver the content to you. So let's take Nike as an example. I believe they report earnings next week on June 26th, but the stock has, and I'll show you the chart in a minute, but the stock has come down quite a bit. I just want to show you one one resource that is helpful is if you have Robinhood and you have Robinhood Gold, then you should be able to, in your Robinhood app, find this research report section. And this is populated by Morningstar data. So Morningstar is an analyst group. I've found their valuations to be pretty good. And so they rate Nike as a five-star stock with a fair value of $112. And the uncertainty is what you have to pay attention to with Morningstar. This is medium. I like to look at stocks that are five-star range with low or medium uncertainty. And you can read the full report if you want. You can read the thesis. You can learn a lot about a company. They don't analyze every company, but they analyze a lot of the popular ones, and you can look at their fair value analysis, how they got to the $112 valuation, whether the company has a moat, things like that. So by the time you read through it, you will be more well versed in the stock than probably 99% of people. So now let me switch over to the chart. So this is Nike's chart on TradingView. You can see this is the daily chart. And I've got a few moving averages here. You can see it's hit a low back with the tariff announcement on early April. And so you can kind of see that it does have a bit of support down in this area, right? Which is $52 range. Right now, it is trading here in this area, which is about 60 bucks. And there could be some support here. You can see there's a gap up here, and then it's kind of traded in this range. Well, I think it's undervalued based on the Morningstar data. And I would like to take a position in Nike. I actually do already have some positions in Nike, but let's say I'm just analyzing this stock. I find that it's undervalued. It's not crazy overbought or anything, and it's near its 52-week low. So one strategy that I want to talk about in this video, which I talk about in my book, let's go over to the whiteboard. One strategy is the put credit spread. So that is the first strategy I will look at whenever I'm looking to start a position in a stock. So this is abbreviated as a PCS. Okay. So I will often start with a put credit spread. And in my book, you'll see that I explain a PCS like an insurance company. So when you are putting on a PCS, you are actually selling insurance. You are insuring the stock. So, for example, we know that Nike stock, this is Nike stock, we know it is trading at about $60 a share. With put credit spreads, I like to do them out of the money, meaning I want to insure the stock lower than the current price. So I might say, hey, I will be willing to buy 100 shares of Nike from Mr. Market if it falls to or below $55 a share. So I would sell the $55 put. Okay. And let me move this here a little bit. But I don't like to do cash secured puts because that eats up a lot of collateral. You have to have $5,500 for this particular trade to put that on. So I like to do spreads. So I will then buy reinsurance. So this is the insurance I'm selling is this $55 one. I'm going to buy reinsurance. So I'm going to buy insurance from the market if the stock falls below $50 a share. So I'm going to buy that $50 put. So I sold this 55 and I buy the 50, and this should give you a net credit. So essentially you collected some insurance premium when you sold this one. You spent a little bit of your insurance premium to buy this one, and then net you still have positive cash flow. And so you're creating essentially a mini insurance company. Your business that you're creating from options is a mini insurance company. And in the book, I explain that this is just like Warren Buffett, how he started his business was through insurance. So he would collect premiums. This is what you're doing with this net credit. If there are no claims made, then he gets to pocket that. And then he can take that premium and he can invest it in other things. And that's how he grew his wealth. So let's go over to OptionStrat so we can visualize this trade. So you can see, let me actually, before you get too overwhelmed, let's go to the graph here. So what we're doing is we're selling that 55 put and we are buying the 50 put. And this is the profit loss graph. I was just going out, can't write on the screen, but in the upper left, you can see this is the June 27th expiration. And so that's in about a week and a half from now. And so in a week and a half, I would get to keep that $73 as long as the stock price is above that $55 mark. So you can see this profit loss graph. I make money in the green here whenever this price is essentially above, 54.27 is the break even. And if I go and I look at the table, you can see my profit over time. This is dollar amount. So I'll collect that full $73. You can see on the far right hand side here on the 27th of June. I get to keep all that. I will have earned all that premium as long as the stock is above $55. So that means the stock could fall 8.3% between now and then, and I'd still be good and profitable on this trade. But you can see each day I make a little bit more premium as time decay kicks in. Now, recognize that you're getting quite a bit more premium because they announce earnings on the 26th. And so implied volatility is higher than normal. So there is a chance for a big swing on the 26th when they announce earnings. So just be aware of that. So that does introduce more risk. I generally don't like to do this on stocks right before earnings unless I'm pretty confident that the stock is selling at a low valuation, meaning it's quite undervalued, which I think it is, according to Morningstar. So let me recap here. Let's go back to my whiteboard, move some stuff around. Okay, we'll do it in this cool rainbow color. I'm gonna make this a little bit thicker. I collect 73 bucks, right? For doing this put credit spread trade. I get to keep that 73 bucks as long as the stock stays above this $55 level. Right now it's at 60 bucks. So I think it could fall about 8% before I even hit that level. Now, if it falls quite heavily, rewrite this. My handwriting's terrible. If it falls dramatically when it announces earnings on the 26th, for example, what do you do? Well, that's where step two of my process kicks in. And I explain this in my book. So PCS is just the first step. I try a PCS trade generally first on a stock that I like. And if it falls, I'm actually happy, believe it or not, because I'm going to take an even bigger position. So if it gets down to $55 or below, I'm going to back the truck up a little bit more. And I'm going to start a call debit spread. I'm not going to go into detail here. That's the next video I want to make in this series. And then if that fails, I even have a backup plan for that. And I am going to buy a LEAPS option. So I'm going to have even more upside exposure at an even better price. So I hope to make a lot of money with this. This is not investment advice. This is an educational video. Do your own research. I just personally feel like Nike is undervalued in the long run, but it doesn't mean it can't get more undervalued in the short run. So you just need to be aware of that and not over leverage, not oversize a position. So if you want to see the next video, like and subscribe. I will put together the CDS video and you can see what I would do in the event this stock takes a beating when it announces earnings on June 26th.